Hey there, fellow investors. Let's talk PB ratio. Sound complicated? Don't sweat it. It's actually pretty straightforward. In the simplest terms, the PB ratio, or price-to-book ratio, is like a measuring stick for stocks. It tells you how much you're paying for every dollar of a company's net worth. Think of it like buying a used car. The car's book value is what's listed in Kelley Blue Book, right? It's based on the car's original price, age, and condition. The price you actually pay? That's the market value. Sometimes you score a deal and get the car for less than book value. Other times you might pay a premium if the car is in high demand. Stocks work similarly. The book value is a company's net worth. What's left after you subtract its liabilities, debts, from its assets, what it owns. The price is, well, the stock price. So, the PB ratio compares a company's stock price to its net worth on the books. It's a quick and dirty way to see if a stock is potentially overvalued or undervalued, but hold your horses. Before you go all in on a stock with a low PB, remember that it's just one piece of the puzzle. We'll dive deeper into the nuances of the PB ratio in the next section. Stay tuned. Alright, now that you've got the basics down, let's crack the code of the PB ratio. Calculating it is easier than you think. Simply divide the current market price per share by the book value per share. You can usually find this information on financial websites like Yahoo Finance or Google Finance. Now for the million-dollar question, what do the numbers actually mean? A PB ratio of 1 means that the stock price is equal to the company's book value. Sounds fair, right? But here's the catch. A PB of 1 isn't always the magic number. A low PB ratio, typically below 1, could indicate that the stock is undervalued. It's like finding a hidden gem in the bargain bin. But be cautious. A low PB could also signal underlying problems within the company. Maybe the company is struggling to generate profits or its assets are overvalued. Always do your due diligence and investigate further. On the flip side, a high PB ratio, usually above 1, suggests that the stock might be overvalued. Investors are willing to pay a premium for the stock, possibly due to strong growth prospects or a stellar track record. However, it could also mean that the stock is caught in a hype bubble and is due for a correction. Remember, the PB ratio is not a crystal ball. It's just one tool in your investor toolkit. In the next section, we'll explore when the PB ratio shines and when it's best to look at other metrics. Don't touch that dial. So, when is the PB ratio most useful? It's particularly handy when evaluating companies in asset-heavy industries. Think banks, real estate, or manufacturing. These companies have lots of tangible assets that contribute to their book value. The PB ratio can give you a good sense of whether you're paying a fair price for those assets. However, the PB ratio isn't as reliable for companies with a lot of intangible assets, like tech companies or pharmaceutical giants. Their value lies in their intellectual property, brand recognition, or future growth potential, things that aren't fully captured on the balance sheet. Now let's compare the PB ratio to some other financial metrics. One important metric is the price-to-earnings (PE) ratio, which compares a company's stock price to its earnings per share. While the PB ratio focuses on assets, the PE ratio emphasizes earnings. Both ratios are important, but the PE ratio is generally considered more relevant for growth investors. Another key metric is the return on equity, ROE, which measures how efficiently a company is using its equity to generate profits. A high ROE combined with a low PB ratio can be a powerful signal of an undervalued stock. It's like finding a gold mine. Remember, no single metric tells the whole story. The PB ratio is most effective when used in conjunction with other financial ratios and qualitative factors. In the final section, we'll tie everything together and leave you with some key takeaways. Stay with me, folks. We've covered a lot of ground today, so let's recap the essential takeaways for all you beginner investors. The PB ratio is a valuable tool for assessing a company's valuation, especially in asset-heavy industries. It can help you identify potential bargains and avoid overpaying for stocks. However, don't rely solely on the PB ratio. It's crucial to consider other financial metrics, such as the PE ratio and ROE, to get a comprehensive view of a company's financial health and growth prospects. Investing is like a marathon, not a sprint. Don't get caught up in short-term market fluctuations or chase after the latest hot stock tip. Instead, focus on building a diversified portfolio of quality companies that align with your investment goals and risk tolerance. Remember, knowledge is power. The more you learn about investing, the better equipped you'll be to navigate the exciting world of the stock market. So, keep learning, keep exploring, and most importantly, keep investing in yourself and your financial future.